I think the question everybody's trying to figure out today as we count down to the jobs report, how insightful to the monthly jobs report is that ADP report? I mean, just doubling estimates, really a blowout report.
Zooming out, they do track each other, not month to month very well. There's a lot of noise in the data, but there are lots of reasons to expect another blowout report. Just, zooming out, anyone who's gone on vacation lately, anyone who's gone to a restaurant or an airport knows that America is understaffed. Economic activity is pretty much back to the pre-pandemic trend, but employment in most industries still is not. And so we can expect higher than average hiring going forward.
Okay, so I'm with you. I actually just took a flight somewhere, and you're right. I mean, everywhere you go, the restaurants are packed, everything's packed. A lot of the gains so far this year have really been in the hospitality sector and the leisure sector, which you're pointing out to. Those places are hiring. What other areas are we expecting to see possible job gains or maybe even job losses?
So job growth has been historically broad-based, even in the most recent months, and despite this huge increase in interest rates. We've even seen gains many months in industries that usually shed enormous numbers of losses when interest rates go up. All eyes, I think, should be on the areas where we are seeing more weakness in goods-related industries that are suffering from a return to normal pre-pandemic behavior, in manufacturing and construction that are very interest rate sensitive. Tech remains the biggest weak spot. In the JOLTS report that we got earlier this week, that's an industry where quits are now lower than they were before the pandemic, where layoffs are higher, and that's really an exception, though. The rest of the economy is doing quite well.
So you mentioned the JOLTS report. We've been talking a lot about ADP, but the JOLTS report also came out. But in your mind, there were some mixed signals there. Give us an explanation of the signals that you believe are mixed.
So yesterday was an interesting day with mixed signals indeed. A 500,000 drop in job openings, 500,000 decline, but a 500,000 gain in the ADP report. And that is what economic data has been like for the last sort of 18 months. It's been quite difficult to figure out if we're slowing down, if we are approaching a soft landing, or if the slowdown is something larger and more concerning. And we need more data, more reports. All eyes will be on this jobs report today and also on the CPI and other inflation reports next week.
Joe, you sound like the Fed. More data, more data, more data. So I want to ask you, if we do see a hotter than expected jobs report, a lot of people think that's going to pretty much seal that we're going to see a rate hike later this month and maybe even another one later this year. If we see one more hike, maybe even two more, how does that impact the job market with that increased cost of capital?
So, first of all, I don't think that that's necessarily the case. Inflation is coming down quite markedly now. The private sector measures of inflation actually suggest that we're much closer to that 2% target than the official statistics suggest. And last month's CPI report was much higher than it should have been because of used cars and things that we already see have reversed in private sector data.
Right. Wait, so very quickly, what private sector data are you looking at that's showing inflation cooling more than what the Fed's looking at, which is CPI and PCE?
So there are real-time indexes that use rent from Zillow and house prices from online marketplaces. There's a really nice online inflation index that comes out. It's called Trueflation, and that suggests that we're much closer, below 3% already.